Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. Last week we had an epic edition of Ask the Guys, so much so that we've bled into this week. It's another edition of Ask the Guys, your great questions and our best attempt at answers today on the Real Estate Guys radio program. Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2020 Goals Retreat, January 17th to 19th in beautiful Lake Las Vegas, Nevada. This unique weekend has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at realestateguysradio.com under events, or call 888-489-7723, extension 18. Get your life back on track, physically, spiritually, and financially. Attend the 2020 Goals Retreat on the third weekend of the new year. Click events at realestateguysradio.com to register. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723, extension 18 today. Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. We're in the last month of the year, rounding the home stretch. Let's say hello to our co-host, the financial strategist, Russell Gregg.
Hey, Robert.
This year has flown by. In fact, we like to do Ask the Guys. That's where you submit your questions and we come up with answers. We like to do that every 8 weeks or so, and we got a little bit behind. Last week we had a great show. We couldn't even get to half the questions. So we've got another edition today. If you have a question for the Real Estate Guys, just go to our website at realestateguysradio.com. Under the button that says Ask the Guys and fire away. We certainly can't answer every question we get. We barely answer 5% of the questions we get. And that doesn't count the folks who are just writing in to be guests on the show. But we have some great questions for you today. In fact, some really thought-provoking questions. Here are the basic rules. Russ and I are not tax or legal professionals, and we don't give advice. We simply give ideas and information. So with that, let's go to question number 1. This comes from Lanidia in Forney, Texas. By the way, Forney, Texas is the antique capital of Texas, in case you didn't know that. There's early real estate trivia for you. Here's her question. I have $16,000 left in an old 401k plan from a previous employer that's just sitting idle. We want to invest this money in maybe real estate or somewhere that would give us a profit within a year or two. What is your advice for a first-time investor? Thank you in advance. All right, well, first of all, we don't give advice. And having said that, secondly, everybody who invests has an investment timeline or horizon. Sometimes we invest in something we don't expect it to pay off for years, like timber. People that buy timber aren't expecting to see a payoff for 20 or 25 or 60 years. Sometimes we get immediate return, like when we buy an existing rental property and the rent comes in every month. So every month there's money coming back in. So the duration of investment is always going to be important. And anytime you're looking for return in a short period of time, just know that that completely limits the things you can invest in.
Yeah, so any investment comes down to personal investment philosophy, and we talk about this all the time. With that said, when you get into retirement account investing, which is what we're talking about here, you're limited in some of the things that you can do, and there's some risks that are out there for you if you're not sure what you're doing. So I would say the very first thing to do as a first-time investor is to get educated. That's your first and best investment. The good news is it doesn't cost that much. In this particular case, you're trying to learn about 401k plans, and there's different types. There is the 401k plan you get when you go to work for an employer, and they dictate what it is and what it's invested in, and you have limited choices, although you can borrow some money out. In this case, you have a rollover. In other words, you have a plan that you developed with an old employer, and now it can be rolled over into a self-directed 401k or retirement account really of your choice. And again, check with people. I'm not giving you advice, just ideas and information. Or you may be eligible if you're self-employed or could become self-employed, either part-time or full-time, to get a solo 401k, which gives you even greater flexibility. One of the things to be concerned about when you have a little bit of money and you want to do real estate is you think about it as a down payment. The challenge is when you use a down payment in a retirement account, you're going to have a little bit more difficulty getting loans. That's one consideration. But the second thing is when you earn profits on that money, you subject yourself to a hidden tax not a lot of people find out about until they get to the end of the transaction, and then they get a big, ugly surprise. So rather than get into all the weeds about all that, what you can do is send an email to qrp@realestateguysradio.com, and you can learn a little bit more about qualified retirement plans with a paper written by our expert on that, Damian Lupo. That's qrp@realestateguysradio.com. But I definitely would say start with getting educated and just understand with that amount of money and being in a 401k plan, you're going to be a little bit limited. You may end up wanting to put that into a private placement if you're qualified to do that. You might want to get involved in some private lending. You could use it as an option premium to purchase a real estate option or something where you could get a big pop. But in order to do all that, you're going to have to learn what your options are, if you will. And then once you understand that, then you're going to have to look around for the kind of deals that fit what you're able to do.
You know, the timeline is also just challenging. If you're trying to profit within a year or two, that and a retirement plan don't usually go together. For most people, their retirement plan isn't something they're going to see yield or return on for many, many years. Now, we don't know much else about you. Maybe you're at a point in your life where it's time to start taking distributions from retirement. In that case, you're going to make different choices about where you invest the money. One of the big advantages of retirement account investing is that it isn't subject to the same taxation, but that's a whole can of worms. So I think go get educated about that. Definitely you can do a rollover from your previous employer's 401k plan. That's easy to do. You just got to figure out how to do it. And then just really make the decision about what you're after. In a short period of time, you might be able to put a second loan on a property or something like that. But again, it's going to take a little more scope. I think the big advice that we have, if we can give advice, is just to continue your education. So thank you very much for the question. Our next question comes from Christopher in Anchorage, Alaska. Hey guys, love your podcast. Now, I'm stuck in a repetitive grind. By trade, I'm a construction driver and operator, mobilizing and demobilizing large equipment across Alaska, as well as working on the North Slope oil fields, building exploration ice roads for drill rigs in the winter. Wow, now that's a gig. In 2013, I started purchasing multifamily real estate. To date, we have 7 buildings, a total of 26 units, and 2 of the buildings, 11 units, are gutted and not performing.
Ouch.
Both those properties became a larger expense once construction was underway. No. A quote of $80K in 4 months turned into $300,000 to $500,000 per building within a 1-year time frame. Well, that's
just a couple weeks.
Luckily, we only put in about $200K into these properties before absolutely drowning ourselves. I suppose what I'm getting at is I'm pretty burnt out with my career, and I'm currently sitting on 2 non-performing properties. How would I find a buyer for the 7 and 4-unit buildings that have been gutted and some work's been done on the 4-unit building, like shower inserts and new interior framing? We just really need to find a buyer that wants to finish these properties or an investor willing to front the funds so we can have them done and flip them for a cash out. With everything going on, we're just sitting on them and waiting for an opportunity to sell, but really have no real direction. Please tell me that you've seen and helped with this issue before. Thanks, Chris, the Alaskan heavy haul guy. Well, absolutely. We've seen a situation where we have idle equity, that is property that's just sitting there not doing anything. And while the highest and best use is to either do the work and sell it or just get rid of it at a fire sale, it doesn't seem to happen because of everything else tugging at your attention. So very, very common to have what we call a don't wanter of real estate. Now, you've already established that you want to own multifamily and you have properties that are performing. You just got a couple that aren't. So the real essence of the question is, how do you get rid of a property you don't want? Because I'm going to assume, based on everything you said, that as much as you still want to invest in real estate and you appreciate your performing buildings, these are just weights around your neck that you want to get rid of. Well, here's the reality. Any property will sell at the right price. Any property. The right price is the part of it. You've got to find someone who is willing to pay something that you're willing to take, who is also willing to take on the liability and the workload of what it takes to turn these properties around. So that's the big deal. Or, as you said, you might find someone who's willing to kind of put a stake in and fund the turnaround. And those are two different things.
So anytime you're looking at an investment decision and you're looking at something, you have to look at it in its current condition. So whatever it is, it's worth something in its current condition. That's kind of your baseline. And then you have to look at what the potential is and what it's going to take then to bridge the gap between where it is and what its potential is. If you can do that as a profit, you have an opportunity. Now, it may not be an opportunity for you. Maybe your job, maybe your credit, maybe your access to working capital, maybe your expertise, or maybe just your desire of what you want to do with your life energy. Don't make it an opportunity for you, but it could be an opportunity for somebody else. But in order for you to understand that, and know how to price it and know how to negotiate once you get somebody to bite at your offer, then you're going to need to understand what is the potential. So think about the difference between where it is and what it could be. And sometimes when you're locked into a property you don't like or you don't want, you can't see the potential. So if you have other investors in your life who are experienced people that can come look at the property, that know the market and can help you understand what the opportunity might be, if they see it, they may go, hey, there's a lot of opportunity here. That may solve two problems at the same time. So draw on your social network in order to see what can be done. The second thing then is once you determine what you need to get it done, now you know how much meat there is on the bone, or the theoretical bone, if you will, and then you can decide how you would want to divvy that up. If you decide, hey, I'm going to run this project, I'm going to do it, I'm going to see this thing to fruition, and I'm going to divvy that up with whoever brings the capital, great. The challenge that you're going to have is this thing croaked on your watch and it didn't come in on time or on budget. So you've got to understand why that happened for two reasons. Number one is so that you get the lesson. You don't want to be out there trying to be a professional investor if you're laying eggs. If it's because you were busy with your day job and you couldn't pay attention to it, then you probably don't want to be the guy running that project going forward. And you wouldn't want to pitch an investor on putting their capital at risk when you're not going to be able to mind the store. So in that case, you're going to want to hire somebody that can help you do it. And that's got to factor into the cost it takes to get it from point A to point B. Now, the other reason is you got to have a good explanation for what happened is because when you go out there to raise money, you better have a good reason for why this is not going to happen again if you're capitalized. So you've got some work to do, but before you spend any money, the thing is you've got to do some homework. And that homework is just understanding what do you have? What could it be? What's it going to take to get there? And are you the right person for the job? If you're not, what's it going to cost you to get the right person for the job? Now you've got all the pieces to the puzzle and you can take it to market and begin to negotiate. At some point, you may just look at it and go, hey, you know what? I've got these X number of properties, 70, I think it was. I've got two duds. I'm just going to take a loss on them and move on with my life. And then if you decide later on you want to syndicate, again, you just have to be ready to give a plausible explanation for why you have those blemishes on your record. Nobody gets through this business clean, so it's okay to have some dogs. That happens to the best of us. Just make sure that you get the lesson and you have a way to explain the story when the time comes.
And you have to do the math, right? If you've already got 200 grand into these properties, it's going to take another 300 to 500 per building. Once you've done that, what's the exit price look like? If it doesn't make any sense, you may have to cut and run, as Russ suggested. One more thought about this, a nuance is this. The financing on the commercial side, once these properties are fixed up, is going to be different on these two buildings. For the 7-unit building, that's a commercial lender because it's more than 4 units. But the 4-unit building might be able to attract some 1 to 4 unit financing, and that might put you in a little different position. You also, because it sounds like that's the building that the most work has been done, that's kind of where I would start. You could find someone who wants to be an owner, operator, even someone who would live in one of the 4 units and do the work. You might find that person easier than you're going to find somebody for the 7 units. That's just my 2 cents, but sounds like you got some work on your hand, but keep up the listening and the good work hauling around with that difficult and crazy job. Maybe a reality TV show about that job might generate the capital you need. I don't know.
Yeah.
There's Chris. We've got more when you come back. It's Ask the Guys today. Your questions, our answers on the Real Estate Guys radio program.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
When it comes to successful rental property investing, it pays to be picky. Pick the right markets, pick profitable properties, and pick great property management. That's easier said than done, but we've got great news. Jerry Kerr and his rockstar team at Mid-South Homebuyers are going strong in Memphis, Tennessee, and Little Rock, Arkansas too. So for a top-notch turnkey single-family home rental property, whether you're a new investor or have a large portfolio already, pick Terry Kerr and Mid-South for a truly A-plus investing experience. To learn more, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hi, this is Garrett Sutton, Rich Dad's advisor. Remember, equity happens, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. You can find us every weekend on this great radio station or all the time at realestateguysradio.com and your favorite podcast outlets. It's Ask the Guys. Your questions are answers. If you have a question for the guys, go to the Real Estate Guys site at realestateguysradio.com and click on the button that says Ask the Guys. It's now time to head down the rabbit hole. We've had a few questions that have been piling up that are kind of interrelated. So the next group of questions have something to do with one another, and different great listeners have done some research and reading, and we're going to share these with you. So open your mind. Here we go. This comes from Jason in Merrick, New York. Hey guys, with the recent creation of billions of dollars pumped into the banking system, do you see this negatively or positively impacting or having no impact on the real estate market here in the U.S.? Thanks for the great content, and please don't ever stop. Well, 22 years so far and counting, about to enter our 23rd year of broadcasting. So I think eventually we'll have to stop, but not until we have to. So, all right, Jason, great question, right? There is not just in the U.S., in lots of countries, there is what we would term quantitative easing, according to our Federal Reserve, but the printing of money. When we create billions of dollars out of thin air here and in other countries, there's lots of ramifications.
Yeah, well, Federal Reserve Chair Jerome Powell, when he did this latest round, was very careful to announce to the world that this definitely was not QE.
No, not.
We call this QE the not QE.
Right, it's called something different.
Yeah, so they're definitely pumping billions and probably bordering on trillions, or at least on pace to be on trillions a year or over $1 trillion a year into the system. So yeah, it's substantial. The thing is, there's a couple things to think about. Number one is a lot of this gets into the system and it doesn't get back out again, and that's how they contain it. So the more of it that leaks out into the system, the more likely you are to see asset price appreciation. People who have access to the capital through whatever means are able to bid up the assets that are in demand. With that said, there's a lot of motivation on a lot of people's part to prop up real estate, because bankers make loans against real estate, and those loans go bad if the real estate prices drop. Voters live in homes, and if the real estate prices go down, they're angry at the politicians. So politicians are very motivated. That's why you see a lot of effort to create subsidized financing, easing lending guidelines, doing things to try to create more opportunities. Investors are looking for income in a yield-starved world when you have government sovereign bonds yielding negatively in many parts of the world and very, very low in other parts of the world. To get a little bit of extra bang for their buck in terms of bonds, people like to invest in mortgage-backed securities. And That's the way they tap in to that stream of rental incomes. Real estate investors, we want to do it by collecting the rents, but they don't want any of the brain damage that comes with being a landlord. So they're happy to make the loans against the real estate and let you do all the heavy lifting. Of course, in exchange for that, you get the equity, and that's great. So all that to say, the more money that gets pumped into the system historically is good for real estate in the long term. Now, sometimes it creates major disruptions in the credit markets, and when that happens, credit markets dry up like they did in 2008, and that has a negative impact on real estate asset prices. But if you're a cash flow investor and you're controlling your real estate with prudent cash flows and long-term structured debt that isn't going to be called or adjusted up, you have staying power and you can ride that wave out. If prices were to crash again, I think it would be fair to expect that all the powers that be will do exactly what they did last time, which is funnel lots of money into real estate until they can reinflate it. During that shift, there's an opportunity, if you're structured properly, to be on the winning end of it. And so we're probably, I think, with some of these additional questions, what I got a chance to preview, we're going to be talking a little bit more about that as this episode progresses. But generally speaking, I think real estate is a winner when there's more money floating around in the system. But you can still be a loser if you have your deal structured improperly or you're in the wrong market or serving the wrong demographic. So those are things we talk about a lot on this show. You can go back and listen to the past episodes, but you need to be strategic about that. Not all real estate is going to be a winner, but generally speaking, real estate is.
So if you're new to listening to our show, we don't just talk about real estate specifically. It is our focus and it's our center mass. But we believe that before you're a real estate investor, you're an investor, meaning you have excess capacity and your earning ability, and you put that money into the market to work. And so you need to understand kind of all investments. So I wouldn't just say go back and listen to other shows. I think if you're new to this, you're going to need to listen to this show more than once. And that's the great thing about podcasts is if you're not sure, back up a little bit, listen again. Repetition is the mother of skill. Here's a thing to get your mind around as we go into the rabbit hole today. And that is the value of the U.S. dollar, and every other currency, by the way, but just stick with me. The value of the U.S. dollar over the last 100 years has been in a single direction on a trend line, and that is down. So when you hear in the news that the U.S. dollar is stronger, it's only stronger against other currencies, and currencies aren't real. They're all brought into existence in a fiat system, so they're not backed by anything of substance. That's hard enough to get your mind around, but follow me on this. The dollar has been worth less and less and less. When Russ and I were growing up, you could buy a soda for 10 cents. Today it's $2, right? So that's the same soda, really with the same recipe in many cases. It's just costs more today.
It's complicated. Sugar and water and a little food
Exactly.
coloring.
So here's the point. When there's more dollars, the value of each one is less. But the price expressed in dollars goes up. So over time, equity happens, meaning the property goes up in value. But you know what stays the same? The value of the debt against it. So we call that shorting the dollar, when we can hold on to real estate via debt, and the debt is at a fixed amount of those dollars. So I buy a property for $100,000. I put $20,000 down as my down payment. I get a loan for $80,000. The property goes up to $500,000 over some period of time. I have to pay off the $80,000, but even the $80,000 has gone down because of amortization, the slow pay down of the principal. So the point is that $500,000 house isn't really worth more all those years later, because the value of every dollar is worth less. Rather than buy a $4 coffee at the coffee shop, you're going to be buying a $16 coffee at the coffee shop. It's the same coffee, you're paying more for it. But the fact that the mortgage portion got paid off in later dollars means that you got to short the dollar. So we love leverage for that reason and many others. So it takes a while to get your mind around all this stuff. And we're going to be delving into a lot of really cool stuff today, as much as we have time for. But I'm in agreement with Russ. For the most part, we see a positive impact for those dollars. You just have to be clear that as your rent goes up, those dollars are worth less too. I bought my house for $100,000. It's worth $500,000. You didn't really make $400,000. You think you did. You didn't really, because every one of those dollars is worth less than it was going forward. So it doesn't mean we don't want to invest. We want to stack up properties. We want to create cash flows. We want to create equity growth. But just remember, dollars are only equal to dollars today, and it's same for every other currency out there. So let's delve into some more questions. This one comes from Ed in Fort Mill, South Carolina. Hey, you guys have changed my life with your fantastic podcasts, seminars, and beer chat sessions, so thank you. Well, thank you, Ed. It has been nice getting to know you as well. Ed comes to many of our events, and a great way to talk with the real estate guys is over a beer, by the way. He says, per the advice I've received from you, Robert Kiyosaki, Simon Black, Peter Schiff, and others, I've gotten out of traditional stocks and mutual funds and have invested in offshore underpriced companies, resort property offshore, residential assisted living, and cash and precious metals. Mostly silver due to the silver-gold ratio. I just listened to the latest Rich Dad podcast where Robert Kiyosaki interviews Bert Doman about what will happen when the credit bond markets crash, which will crash the stock and other markets, which will drive everyone to liquidity, including selling precious metals, causing gold and silver to crash. I hadn't thought about this before, but it makes a lot of sense. We had Bert Doman on the program many, many years ago. He wrote a book that came out in 2006, I want to say, that was called Prelude to Meltdown or something like that. Do you remember that book, Russ?
Yep.
And I remember at Freedom Fest, we got a copy of that and talked to him, and he was sounding the alarm, that's for sure. He says here, back to the letter, Bert predicts the Federal Reserve and other central banks will print money at unheard of rates, causing extreme inflation, which will then cause precious metals to skyrocket. If this is correct, it would make sense to get liquid with cash right now instead of buying more precious metals, so that when precious metals crash, I can use my cash to buy more metals when the price is down and before inflation really sets in. I'm approaching the recommended 10% of our assets in silver, but wonder if it makes sense to instead add more cash until credit markets crash. Lots to think about here, and I always love listening to your thoughts on these issues, even if it takes me a while to understand everything you say. Thanks, guys. Hope to see you soon. All right. Well, there's a can of worms here.
Yeah, there's definitely a lot there. I think to boil it down, what Bert Doman is saying is something that we heard from Steve Kochberg way back at that very first Freedom Fest years ago, which is before you see inflation, hyperinflation, you're going to see deflation. And it's for exactly the reasons that Ed describes here, and that is that when people get squeezed and they begin to see the purchasing power of their dollar fail, they are going to start to sell things in order to raise more currency. And that's a mistake because they'll be trading real assets, things that they own that are real, of real value and utility, and they'll be trading them to get their hands on more paper currency, which is losing value because they need more and more of it to pay for the necessities of life. Eventually, that will trigger more printing of money in an attempt to stimulate asset prices. And the challenge with that is printing of money does not actually create more products. That's why you see in a place like Venezuela is the latest poster child for that. They have a booming stock market, or did before everything crashed. I mean, they had the number one appreciating stock market on the planet denominated in their currency. The problem is their currency wasn't worth anything. And so because they weren't creating real wealth, meaning production, they were creating paper wealth, meaning financialization of asset prices, there was no products on the shelves for anybody to buy, and so the bidding based on supply and demand made everything hyper expensive. The people that had sold things that were of real value in order to raise cash ended up being the losers because the cash ended up being worthless. This is why people run and hide in things that are real, like real estate, like precious metals. Precious metals are great because you can pivot into any currency. If you happen to be in a currency that is losing value rapidly, then you're going to pivot into something else. Earlier, we talked about the dollar getting strong because other currencies are getting weaker faster. A great way to understand this phenomenon is to think about what happens when you jump out of an airplane. When you jump out of an airplane with 4 or 5 other people and you're all kind of falling together, the first person that pulls his chute is suddenly falling slower than everybody else. To the people that are falling, it looks like he's going up, but he's not going up. He's just falling slower than you are. And that's kind of what the dollar is. The dollar is probably going to be the last man standing when it comes to currencies. That's what a lot of people think, unless somebody like China or other people were to come out and issue a currency that would be backed by gold. One of the trends that we've been following this last probably a year and a half, 2 years, is how many central banks are increasing their positions in gold. And there's actually countries now big countries, talking about issuing currencies backed by gold. If that were to happen, all of a sudden the dollar doesn't look quite as attractive as something that's actually backed by gold. So there's a lot to get your mind around. Ultimately, I'm just going to say my personal opinion, which is exactly worth what you're paying for it, is that it's probably a good idea to have some dollars on hand. It's probably a good idea to have some precious metals, which can be used to pivot into any currency in case the dollar ends up being a big loser. But the big way to win, as we talked about in the previous question, is to accumulate debt. Because when you have debt and the currency gets weaker, it becomes easier to satisfy that debt. The people who issue currencies, governments, are all in tremendous debt. They're highly motivated to create inflation. In fact, the Federal Reserve, our Federal Reserve in the United States, it's a charter. It's a mandate for them to create a minimum of 2%. And now they're floating around this idea that, hey, it's been so low for so long, we actually want to overshoot for a little while to kind of bring up the average. All right. So if you understand all that's happening, then you say, okay, I'm just going to kind of dumb it down. I need to have some liquidity in the form of dollars and precious metals, and maybe even some other currencies if you're an international person and you think you might be wanting to invest internationally. Number two is I want to accumulate assets that cash flow so that I can get debt against them while the debt is cheap. Then later, doesn't matter if the asset price crashes because I fixed in my price, I fixed my debt, and as the cash flow will see me through. Think about what happened in 2008. Ken McElroy owned, 100 million, 200 million, whatever it was in apartment buildings. And when everything crashed, it didn't matter to him. His equity all disappeared temporarily, or a lot of it did, but his cash flow didn't. So he just happily serviced his mortgages and actually went and got more mortgages because he could buy things based on his good credit and strong balance sheet. He was able to accumulate, I think, $200 or $300 million more real estate during that period of time, which of course over the last 10 years has gone considerably up. So it's not about accumulating real estate. It's about accumulating tenants and cash flows and leveraging that against debt. And then as the dollar drops, that debt becomes easier to pay off and you end up owning real assets, meaning the real estate and the cash flow that comes with it. Hope all that made sense.
Now, not to add confusion, but there's also, you talked about gold and silver crashing, and certainly the price goes up every day or down every day denominated in a currency. But in reality, gold and silver don't change their value. Gold and silver have the same utility every day, no matter what they are being priced by the market at. And so if gold and silver crash, that just means that the dollar is stronger compared to them. And that could happen, and it has happened. And so that's why Russ's concept of having some cash and some metals makes sense. What you don't want to do in these times is just to completely hunker down and not do anything, because gold and silver, while they play a very important role in somebody's portfolio, don't ever create any return. They're only a way to hold or preserve or to hedge. And we're big fans, don't get us wrong. But too much gold and silver, you're not going anywhere no matter what. Now, there are times when you want to be more heavily weighted, and we could argue that back and forth. But I think the big picture is you've got to make your decisions after you listen to all the experts about where you think the markets are going. And then that's going to help you determine what action to take. It's Ask the Guys, your questions, our answers. When we come back, we're going to ask you a question as we play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide. You're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from February 7th to 10th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 14 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful, the people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. 2018 was the biggest year in tourism Belize has ever witnessed, and this year will likely beat it. How does that translate to real estate investment? That's what you have to come see. There's all types of opportunity in Belize when it comes to real estate investing, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me February 7th through 10th in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market is interesting to you. You've heard about Belize on the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. And we'll have a very special guest. Super syndicator Dave Zook will join us to share how he's raised more than $150 million in the last 5 years and why he loves Belize. To get the details, go to the website at realestateguysradio.com and click on events where you'll find the Belize Discovery Trips. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, February 7th through 12th, 2020. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under events. I look forward to seeing you in beautiful Belize.
Hello, this is Dave Lendiger, co-founder of RE/MAX International. You're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. If you lack clarity or aren't sure where your life is headed, come on out to Create Your Future. The 2020 Goals Retreat happens the third weekend of the new year in beautiful Lake Las Vegas, Nevada. It's like nothing else you've attended. You can get the details on our website at realestateguysradio.com under events. It's Ask the Guys today. Your questions are answers. Before we get back to those, it's time to ask you a question. We're going to play real estate trivia. That's your chance to win a prize by knowing today's trivia question, which of course has something to do with real estate. When you hear the question and think you know the answer, send your best guess to trivia at realestateguysradio.com. Trivia at realestateguysradio.com. First person with the right answer is going to get a great book called Life-Defining Moments from Bold Thought Leaders, a collection of awesome stories by cool authors. That can be yours if you know today's real estate trivia question. Last week on Ask the Guys Part 1, we asked this: what country is the top producer of grapefruit? Well, the answer is China, followed by the United States and Mexico. Here's our real estate trivia question for this week. Name the tallest building in the state of Colorado. Yeah, there's one building taller than any other building in the state of Colorado. What building is that? If you know, or just want to look it up, or guess, send your best guess to trivia at realestateguysradio.com. Trivia at realestateguysradio.com. Include your name, the answer to the question, and your mailing address. Because if you're the first to get it right, we're going to send you life-defining moments from Bold Thought Leaders. That's today's real estate trivia question. It's Ask the Guys. We like to do this show every 8 to 10 weeks, and we got a little bit behind. Had a great show last week with a bunch of excellent questions, and there were all these questions about where the market's headed and protecting yourself in a downturn and all that stuff. So we've bunched a bunch of those together, and we're going to continue in that trend. This one comes from Chad in Baker Ranch, California. Hello, Robert and Russell. I want to start by saying how much I've appreciated your weekly podcasts. Well, thank you so much. I currently own investment properties in both Texas and Oklahoma, and as I continually work to increase my financial IQ, I find you guys are playing an integral part in that development. Currently, I'm focusing on asset protection. And for Ask the Guys, the point I'd like to comment on is related to a recent article I read by Harry Dent. And he gave us a link to the article, which, of course, in real time here, you can't access, but we'll give you the gist of it because Russ and I have both read it now. I think Harry makes a compelling point about a coming correction that will include the real estate market. If you recall, back in 1991, the Japan markets crashed. Prior to that, Japan had been buying up tons of real estate in the U.S. and worldwide. In fact, I remember saying to a friend that the Japanese are buying up everything here in California. Once the crash in Japan occurred, the sell-off began and prices plummeted. Today in California, the Chinese are buying up everything. The new housing tract here in Orange County, where I live, has all been bought up by Chinese. Harry thinks that a crash is coming to the Chinese market and there will be a big sell-off in the real estate markets worldwide. As a result, Places like Vancouver, British Columbia, California, London, etc. will see dramatic price reductions. Looking out for everyone's best interest, like you guys always stress, if you're in cash flowing real estate, you should be able to ride out a downturn in the real estate market. I'd like to hear your thoughts. All right, Chad. Well, I will tell you this. I've had a chance to have meals with Harry Dent 3 times in the last 6 months. So I was always a reader of his stuff, but now that I've got to meet him and spend some time with him, I'm really impressed by his whole demographic studies. He's brilliant at that. Russ and I have both been through this article. He makes the case that real estate continues to be overheated, and the basic premise of that is all wrong, how real estate shouldn't just go up and up and up and up forever, and he has some reasons he believes that. He talks specifically about when at certain ages real estate buyers peak, like when first-time buyers peak, when retirement buyers peak, when second home buyers peak. It's fascinating stuff. In fact, Harry's given that presentation at the Gene Garino's event this last year at Ral NatCon. Good stuff. Anyway, there's a lot to get your mind around here, but the big premise is if China crashes, what happens to real estate in other places?
Well, actually, it's already happening. So New York is experiencing some drop off, and that's one of the favorites for Chinese investors, foreign investors. So you have to think about the mindset, and that's really where it starts. How you think and what you believe affects what you do, and what you do affects the results you produce. Robert Kiyosaki's trademark book, Rich Dad, Poor Dad, attacked the way people thought about investing, that the way they thought about assets, what they thought wealth was. And he's really the person who began to get people to think it's not about buy low, sell high. It's about accumulating cash flows, that the true freedom is passive income. When the Chinese are buying these properties in these well-known markets, just like the Japanese did before them 30 years earlier, they were buying it as a place to preserve wealth, not build wealth, preserve wealth. They were buying marquee properties in marquee markets in the country of the world that has the most stable government and the most tried and true proven property rights. So that's where they wanted to park their money. They made their money elsewhere. They weren't using real estate as a vehicle to build wealth. They were using it as a vehicle to preserve wealth, just the same way we use gold and silver today. We don't use it to make money. We use it to preserve wealth. So you have to understand that mindset. I read this article, and I love Harry Dent. I think he's brilliant. I think he is another guy like Robert Kiyosaki that changed the way people think. If you listen to us and you read our writings, you know we pay a lot of attention to demographics, and Harry Dent is a big reason we learn to pay attention to demographics, and that's an important part of the puzzle. But the premise of his article is about housing, and he's talking about housing prices crashing. They probably will. Because at some point, you can only create so much debt in the world, and then people can't afford to debt service. In the article, he talks about a great restructure of all of this debt that's out there. That's probably going to happen. The debt that gets restructured in a crash is the bad debt. It's the debt that people took out against properties they couldn't afford. He talks about buying real estate, and he's talking housing now, as being an emotional decision. Well, if you've ever gone and applied for an apartment loan and you've tried to make an emotional decision and overpay, guess what? Your lender won't let you do it because it's not emotional to them. It's math. And if the property doesn't pencil by cash flow, you're not overpaying. As a homeowner, you can do that. You can go 30, 40, 50. In some cases, the lenders would even allow 55% of your gross income to your mortgage payment. No commercial lender is going to permit that. So it's just a completely different approach. I'm not saying he's wrong. I'm saying as a real estate investor, you're probably not investing in the kind of real estate for the same reasons. If you're out there and you're buying a home and you're paying for it out of your own pocket or with negative cash flow, meaning you're subsidizing it, and you're betting on the appreciation, you're playing a risky game. You can play that game on a small scale if you've got good confidence in your income. And if you win, you can win pretty big, relatively speaking. But you can't play that game on a large scale. There's no way to do it. You don't make enough money to underwrite that type of thing. So when we talk about real estate investing, we're talking about investing in properties with debt, with positive cash flow, with the intention of us being able to ride out a downturn. Now, the other thing that Dent talks about in this thing, which I think is great, is he talks about Australia, the Australian market, and its dependence upon China. Now, you may not think that matters to you, and it doesn't maybe directly, but the point is, wherever you're invested, whatever market, whatever demographic, whatever product type, you better have a good understanding where your income is coming from. The Australians, the smart Australians, understood that a lot of their economy was based on the China boom and China buying natural resources. We did some investing in Australia, and so I took some time and studied the market, said, where's the money coming from? Where's all this demand coming from? It was coming from the Chinese. The prosperity was coming from the Chinese. So if I'm sitting in Australia and I'm going, oh, gee, my biggest customer, if you will, my biggest source of income is getting ready to take a dip, you better get ready for that. If you listen to us talk about markets, you've heard Robert say many times how important it is a market have multiple stories, not just one story, not just one driver that is driving the economy, but at least 4 or 5 solid drivers. That's why a marketplace like Dallas coming out of the recession was one of our favorites, because it was a very diverse economy and it was based on energy, which we didn't think was going anywhere. And we learned that from Kenny McElroy, and he was right. It didn't. So in other words, you don't need to be afraid of a crash. If you're positioned well, you'll ride it out. And in fact, you'll get wealthier by being well positioned to take advantage of it. But when you listen to people talk doom and gloom about real estate, most of the time they're talking about housing, and most of the time they're talking about asset prices. And most of the time as a professional real estate investor, you're not thinking or approaching the problem the same way they're talking about it.
The article is called Get Ready for the Real Estate Reset by Harry S. Dent. And if you search around, you can probably find that. I think the big takeaway from this is just that when you hear anybody talking about real estate, many of the journalists who are covering real estate are covering housing, the housing market, specifically the owner-occupied housing market. That's different than what we talk about here on the Real Estate Guys. We're talking about investment real estate, and it's still subject to ebbs and flows and ups and downs and all that stuff. But definitely Harry live talks about the difference between a cash flowing apartment building or residential assisted living complex and the houses people are living in. Great question. We've got more questions when we come back. It's Ask the Guys today on the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Do you have a self-directed IRA invested in a syndication? Guess what? It's a ticking time bomb. Why? Because IRAs get hit with UBIT taxes, even Roth IRAs. Hi, I'm Damian Lupo, and we fix this problem for you forever. It gets even better because using the EQRP, you can literally get rid of taxes from all of your gains forever and protect your nest egg. The EQRP is the best vehicle to get it done. IRAs can't do it, not even Roth IRAs. You see, UBIT happens whenever any type of IRA invests in anything with debt. Don't worry, even if your IRA is already invested in a deal, we can kill that tax. Our team at Total Control Financial is here to give you control of your retirement money and free you from that deadly IRA tax forever. Want to learn more about the EQRP? Send an email to eqrp@realestateguysradio.com. I'll email you my special report and send you a copy of the QRP book. Paying a 37% UBIT tax is stupid. First step to getting rid of that tax is to send an email to eqrp@realestateguysradio.com today.
Hey, it's Kyle Wilson, Jim Rohn's 18-year business partner, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. So great to have all these questions from our listeners. It's Ask the Guys today. If you have a question for the Real Estate Guys, go to the website at realestateguysradio.com and click Ask the Guys. This question comes from Justin in Ludlow, Massachusetts. Hey guys, first I'd like to thank you for all of your time and effort in sharing this information week after week. You've made a large impact on both my investing practices and philosophies. But I'm curious to know how a real estate investor can get liquid in preparation for a possible downturn. I'm currently in the process of putting a line of credit on a couple of properties I own free and clear. Would this be considered getting liquid, or are there other ways of doing this? Thank you again. Justin, that's a great question. Markets go up, markets go down. If we think we're in a downturn, we may want to have some liquidity for a variety of reasons, but there's more to it than that.
Well, this is the beautiful thing, and this dovetails, and I really appreciate, Robert, the way you put these questions in the order you did with what we just got done talking about. Not only should you not be afraid of markets going up and down, you should welcome it, because there's an opportunity to accelerate your wealth building in doing that. And it's by understanding that these things cycle. And so when you're on the upside of a cycle, like we are now, and a lot of equity has happened like it has now, and as the powers that be who have a vested interest, as we talked about earlier, in keeping asset prices up, make lending more readily available and interest rates lower, as they've been doing, you have an opportunity to harvest some of that equity. The challenge with putting a line of credit on is that if you don't draw the line of credit can be canceled before you have an opportunity to use it. You cannot look at that equity as being permanent. In fact, you should really think of your equity as being fickle. The market gives, the market takes away. When the market gives, real estate, unlike a lot of other things, gives you the opportunity to take your profits, if you will, take your chips off the table without having to relinquish the underlying asset. When you do that by taking out permanent financing, a long-term loan, you never want to borrow short to invest long. And so use long-term financing when interest rates are down on properties that you want to keep for the long haul, that you believe in for the market, for the demographic you're serving, for the product type, the price point. You think it's going to be resilient in a downturn, meaning that there's people above you who would be putting demand, giving upside demand to your position in the marketplace, because rents typically will not fall anywhere as near as fast as the asset prices will. And now you've got this liquidity that you've created. So cash out, refinance, and then parking that liquidity someplace is a way to do it. Now, you're paying a premium for that, a small premium, which is the interest. Now, you can put it in some highly liquid cash flowing investments that would give you the ability to pivot into property. Then when the crash comes, you have liquidity to go shopping. That's one way. The other way is to build a network of asset-rich passive investors. There's lots of people out there. In fact, we got a question from a listener earlier who said he used to be in stocks and bonds, but he moved out of them because he can see the bubble. And he's like, okay, I'm going to cash this out and I'm going to begin to move into these other things. Well, he's had to take a lot of time to find those other things and develop those other things. He's a pretty enterprising guy. I happen to know him, but not everybody's going to be like that. There's going to be many, for every guy like that, there's going to be probably 100 that have the assets, have the income, but don't have the inclination, the time, or the desire to go out and learn how to do that. That's why we're so big on syndication, because somebody who does like investing, who knows how to find deals and do the due diligence and run the project and structure everything, can get a big network of investors on board that will fund those deals. And here's the thing. Even though rich people get hit in a downturn, they don't get hit as hard as middle income and poor people. So as much as we love poor people, there's not a lot we can do for them except give them free education and hope they can claw their way up. That's great. But for people who are in the middle, who don't have enough assets on their own balance sheet to take full advantage of a sale when it happens, the best thing you can do is build a reputation, build your brand, and build your network with a network of passive investors. Because there's always going to be money. And when there's blood in the streets, if you have educated those people to understand the opportunity and to trust in your ability to go out and execute on a business plan to scoop up distressed assets, you become part of the solution to the problem. We call you the white corpuscles of the economy. You're out there buying distressed assets and getting them revamped and back in service. You're also helping these people put their money to productive use. So you're providing a great service to them. And you get paid to do it by getting a piece of the action. That's why we promote syndication all the time. That's another way to do it.
If you're interested in that, you can come out to the Secrets of Successful Syndication. It happens in March in Dallas, Texas. You'll find all the details about that event and all the events the Real Estate Guys not only produce, but promote at realestateguysradio.com under events. Big thanks to all the listeners that submitted questions, whether we got to them today or not. You may want to go back and listen to the show again to get your mind around it, but the more prudent and the more diligent you are as an educated investor, the easier any downturn will be. Got a great show for you next week as we head into the holiday season. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by
Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.